It's no secret that right now the stock market is at all-time highs in nearly every single sector. The S&P 500 has long surpassed the top point we saw last year in March, right before the pandemic. Various YouTube personalities, including myself, have shown you a number of stats like the Buffett indicator, which clearly show that the market is very expensive right now relative to previous history. So why would anyone buy index funds like the SPY when it's clear that the market is overvaluing the majority of stocks? In this video, we investigate and showcase why buying these expensive stocks may be exactly what you should be doing throughout 2021 and beyond. We start with passive investing, also known as dollar cost averaging. Essentially, it's an investment philosophy that focuses on diversifying across the entire market and continuing to contribute to your portfolio at set time intervals. This strategy is well documented and time tested. In fact, world-class investors like Buffett and Charlie Munger have long suggested doing exactly this.
We may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, this has not been the history of the United States to have these continued low interest rates. So, if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
While it may be boring, this strategy is incredibly underrated when looking over the stats. Most professionals and fund managers have an extremely hard time beating this very simple strategy of continually buying the entire market. This article by CNBC in 2019 outlines exactly this. 9 years in a row, the majority of large cap funds lag the S&P 500. In fact, after 10 years of observation, 85% of large cap funds underperform the S&P. And after 15 years, that figure goes to 92%. But this fact still doesn't answer a simple logical question. Why would you place thousands of dollars into an index fund that is 2 or 3 times overvalued versus historical norms? Is passive investing worth it now, considering the market risk? Why not just wait for a fair price? And that is a legitimate question that is often brushed aside by so-called financial experts. So instead of me answering this, I'm going to let the father of value investing answer, Bogle, the man behind Vanguard and someone who for 70 plus years preached investment over speculation and long-term patience over short-term action.
So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline. Don't let that change your mind. And never, never, never be in or out of the market. Always be in at a certain level. You may want to be 50% in the stocks like I am. You may want to be 75% or 25%. That's probably a decent range. But never be out and think you can get back in, because your emotions will defeat you totally.
One of my favorite Jack Bogle lines is when somebody says buy and hold is dead, or when they ask you, is buy and hold dead, what do you say? You always say, depends on what you buy, right?
Well, buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leave aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google, maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20. So, you're making a good long-term bet, but short-term betting is just not a good way to go.
As you can tell, Bogle believes that money not at work in the stock market is the biggest risk a person can take. If we take a look at the S&P 500, you can see that if you averaged out your buying throughout the last 20 years, you would have made money despite a number of large dips and valleys. What most people won't tell you is why this strategy works. At the end of the day, dollar cost averaging only works because the S&P 500 has continued to ascend upwards for the last 100 years. Now, before you click off and comment that I'm stating the obvious, I want to ensure you know something that many people take for granted. Sure, there have been long periods where our precious S&P stagnated or fell, but in the end it always recovered and exceeded its previous highs. Now we in the United States don't realize the miracle of our economy. The US in the last 100 years has enjoyed a prosperous period of growth and innovation. Despite what many will tell you, the US is the world's leader for economics. We here created the best, largest, and most innovative companies in the world. Other countries cannot say the same thing. Here is the Nikkei 500, the S&P 500 equivalent of Japan. As you can see, it has still to reach the levels it once touched in December of 1989. Had you as a 25-year-old began dollar cost averaging the Nikkei in 1989, you would still be down 50% with an annualized return of minus 2.2%. The same philosophy in Japan would have been devastating. The real reason it works for the S&P is because America has always somehow lifted itself out of the worst of situations. Here is Warren Buffett explaining.
That maybe you were giving a little bit the wrong lesson because all the questions would naturally tend toward current events. And so this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
So what this comes down to is your belief in America. I know there's a lot of negativity surrounding the country in recent years, but still, without any doubt, America is the leader in nearly every single innovative technology you can think of. We Americans are sort of spoiled when it comes to the success of our corporations. And while there is of course problems, there is no denying that the internet you are using right now, the video platform you are browsing, and the phone you use are all thanks to the innovative spirit of America and its continual drive to perform and exceed expectations thanks to the promise of significant profits. So if you think the US will continue this spirit, if you believe this country founded under the premise to continually improve upon its promise to give people the right to life, liberty, and the pursuit of happiness, then buying at any top is sure to be followed with a future that exceeds that one over and over again. That is the American spirit, and that spirit is contained in the value of the country's largest and most successful 500 companies that drive innovation and success. While some may find that fact disturbing, the realization that this country's identity and progress can be measured with the success of its largest corporations, it is without a doubt a truth. While there are problems that need to be addressed, corporations are the lifeblood and the foundation of this economy and largely determine the quality of your life in any part of the world. They breed income, and with income comes taxes. It's no surprise that half of taxpayers pay 97% of all income taxes. And this mighty half is largely supported and funded by the profits created with those companies that are boxed up in the mighty S&P 500. Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed. Also, if you want to support the channel, consider buying some merchandise found right below the description.